Hello and welcome back to Readings in Impact Investing. My name is Daniel Rosehill and this is a YouTube channel with an accompanying podcast which I created in order to get these important reports about the world of impact investing out to people who like to consume this dense information in audio format, including myself. This is a new podcast, and if you are liking it, please send it around with your colleagues who are in the space of impact investing. And let me know of any other reports. There's no shortage of reports in this field, and a lot of them are very important. So if you have ideas for other reports I should cover, please do drop me an email. It's public@danielrosehill.com, 2 L's in Rosehill, just as my name is spelt in the description of this video. All right, let's get ahead now with Chapter 2 of the ITF State of Play report. This is a report that was published this month, as I'm recording this video in December 2023, and this is a progress report on Workstream A of the Impact Taskforce, or ITF, which was about impact transparency. Under the chairmanship of Douglas Peterson, President and CEO of S&P Global, and through extensive engagement of a technical working group consisting of 20 leading global experts, in December 2021, the ITF called for mandatory accounting for impact as a destination, defining accounting as the way in which entities make sense of and act upon financial and non-financial disclosures in a way that can be audited and assured. Our journey has been marked by two key milestones. Firstly, the establishment of the ISSB, chaired and co-chaired by members of the ITF Steering Committee, Emmanuel Faber and Jindong Hua respectively, and its mission to set a global baseline of harmonized sustainability disclosure standards. Secondly, the progress towards robust methodologies for monetary impact valuation. These advancements are paving the way for the integration of financial and impact reporting. At the same time, we highlighted the urgent need for a build on the ISSB baseline for companies and entities to report on and be accountable for their impact. Conscious of the ISSB's seminal work concentrated solely on risks affecting enterprise value. And we insisted upon the need to incorporate social and environmental impacts in public sector accounting and reporting, which is currently largely limited to the disclosure of government spending data. The building blocks of our envisioned destination of mandatory impact accounting by all actors, both private and public, as illustrated in Figure 1 below, are A, the global baseline of sustainability disclosure standards, B, the build on this baseline to include impact on all stakeholders, C, progress on impact valuation, and D, increased impact transparency in public sector accounting. These building blocks must be underpinned by 1, integrity, assurance and auditing, 2, harmonization of standards and comparability of information, and 3, reporting requirements to be mandated across jurisdictions. The following sections provide a brief overview of significant developments across key areas in the last 2 years, highlighting both achievements and ongoing challenges. Our assessment and recommendations were informed by technical input papers from leading global organizations in their capacity as knowledge partners of the ITF. Notably, the IMP submitted a position paper on the need to build on the notion of materiality to account for impacts on all stakeholders, including because impacts give rise to entity-specific and systemic risks and opportunities. IFVI, together with VBA, contributed a technical note on developments in the field of monetary valuation of impacts. SVI reflected on the need, opportunity and challenges to urgently advance sustainability and impact reporting in public sector accounting. These papers can be found in Annex B. A. Establishing a global reporting baseline for sustainability-related financial information. 2 years after we issued our initial recommendations, we are encouraged by the progress made by the IFRS ISSB and welcome the launch of its first set of standards, S1 and S2, on general sustainability and climate-related disclosures respectively. These are effective for annual reporting periods beginning on or after January 1st, 2024, as well as the agenda priorities under consideration for the next 2 years, which include capacity building and other initiatives to promote the jurisdictional adoption of the standards. We also appreciate the efforts of other leading standard setters in key jurisdictions such as the European Commission, which adopted the European Sustainability Reporting Standards, or the ESRS, in July 2023, and the United States Securities and Exchange Commission, the SEC, which is expected to release climate-related disclosure requirements in the coming months, which aim to be consistent with the ISSB standards to reduce the burden on reporting entities while substantially increasing current levels of disclosure. The adoption of ISSB standards is expected to accelerate thanks to their endorsement by the International Organization of Securities Commissions, or IOSCO, and the Financial Stability Board, or FSB, the commitment and support of the G7 expressed in its Hiroshima Leaders Communique of May 2023, and pledges from key global jurisdictions. For instance, Brazil, a G20 member that has mandated the use of IFRS accounting standards since 2010, has recently announced that ISSB IFRS Sustainability Disclosure Standards, SDS, will be incorporated into its regulatory framework. This represents a significant breakthrough as it establishes a roadmap for transitioning from voluntary implementation starting in 2024 to mandatory implementation on January the 1st, 2026. A true milestone for Latin America's largest economy, home to some of the world's most valuable natural assets. The above, coupled with progress made by other countries that are advancing their own national standard-setting efforts in line with the work of the ISSB, see further details and examples below, could represent a significant step forward our vision for disclosure of sustainability-related information to be mandated across jurisdictions in the coming years. Work by organisations like the CPD, which is launching a series of principles for high-quality mandate disclosure, can help deliver our vision by supporting governments and regulators to address key gaps in existing regulation. In fact, according to the SDG Investors Sustainability Finance Regulation Platform, a total of 154 mandatory and voluntary sustainability disclosure measures, including policies, regulations and frameworks, have been officially adopted by governments across 35 countries covered by their database by the end of 2022. Delving further into specific national efforts in 2021 onwards, a number of key Asian jurisdictions have begun developing their own SDSs. They intend to align them with ISSB to ensure interoperability and comparability of information, while at the same time reducing reporting burdens on regulated entities and avoiding double reporting. Countries at the forefront of this process include the following, and this breaks out to a table which I'm going to read through. Australia, whose Accounting Standards Board, that's AASB, published an exposure draft of its initial set of SDSs, building on a previous consultation paper issued by the Australian Territory. And SDS is Sustainability Disclosure Standard, just to give a reminder. Australia, whose Accounting Standards Board, AASB, published an exposure draft of its initial set of SDSs, building on a previous consultation paper issued by the Australian Treasury. These standards will be phased in between 2024 and 2027. The reporting requirement outlined in the exposure draft aimed to maximise alignment with ISSB standards S1 and S2. Japan, which has established a new Sustainability Standards Board of Japan, SSBJ, tasked with developing SDSs aligned with the ISSB framework. Work on the SDSs will commence in 2024 with the aim of releasing the first set of standards by early 2025. These standards will be applicable to financial years starting on or after April 1st, 2025. Hong Kong, where the stock exchange issued a consultation paper on proposals to make climate-related disclosures mandatory in listed companies' annual ESG reports, moving away from their current comply or explain approach. These proposed disclosures seek to align with ISSB standards and cover aspects such as governance, strategy and risk management, aiming for full compliance from the beginning of 2026. South Korea, whose Financial Services Commission FSC announced plans to phase in mandatory ESG disclosures for large listed companies from 2026 and gradually expand to smaller entities. However, there are concerns about reported pushback from a number of companies due to the expected associated costs and legal aspects of tighter reporting requirements. And at the time of writing this report, consultation with key stakeholders in South Korea indicated that the recently created Korea Sustainability Standards Board, KSSB, is open to adopting ISSB standards domestically. While Asia leads the way, promising developments are also emerging in Nigeria, whose Financial Reporting Council announced at COP27 that it aims to become Africa's first country to adopt and adapt ISSB disclosure standards. Given Nigeria's burgeoning influence in Africa and the global economy, this encouraging announcement should be closely monitored and supported as a clear implementation roadmap is yet to be made public. Chile, whose banking regulator CMF plans to begin addressing sustainability disclosures under the ISSB standards. The country currently mandates companies worth over $700 million to issue ESG reports aligned with TCFD and Sustainability Accounting Standards Board SASB, now part of ISSB. Furthermore, it intends to apply the same mandate to most banks and insurers and to all companies with assets of $35 million or more from the year 2025. Argentina, whose central bank recently issued a communication announcing its intention to assess the country's largest banks and a company's compliance with ISSB standards S1 and S2, focusing on climate and transition risks. Greater impact transparency mandated in California. In the US, the state of California passed several Senate bills mandating climate disclosures for companies, including reports relating to greenhouse gas GHG emissions and climate-related financial risks in line with the wider climate accountability package introduced by the current US administration. Pursuant to the new regulations, all private and public businesses generating annual revenue exceeding $1 billion and operating within the state of California will be required to annually disclose their Scope 1, Scope 2 and Scope 3 GHG emissions. Furthermore, these companies will be required to obtain third-party assurance of their disclosures, with Scope 1 and 2 disclosures mandatory by 2026 and Scope 3 disclosures mandatory by 2027, followed by annual reporting thereafter. As mandated by Senate Bill 261, companies will be required to prepare and make publicly available on their websites qualitative reporting on climate-related financial risk and measures taken to reduce and adapt to that risk, applying the frameworks and disclosure guidance established by the Taskforce on Climate-Related Financial Disclosures, the TCFD, successor or equivalent reporting standards, including the IFRS Sustainability Disclosure Standards issued by the ISSB, are also an acceptable framework for reporting. This ambitious move by the world's largest subnational economy, surpassing current and emerging US national regulations, has the potential for a substantial global impact due to its demonstration effect and California's economic significance on the global stage. However, challenges remain. Despite encouraging progress, we have identified areas of concern that require attention and further consideration to foster truly global, inclusive and holistic progress in standard setting and impact transparency. First challenge is inclusivity. Extensive consultation and emerging discussions with and within our global network revealed persistent challenges hindering the truly global adoption of SDSs, Sustainability Disclosure Standards, due to the existence of open gaps that impede their adoption in certain jurisdictions, particularly in the EMDEs. This is important to our agenda given that lack of data and concern about the quality of disclosures are regularly cited as significant barriers to the flow of international institutional capital into EMDEs. To address these challenges, we advocate for enhanced engagement and capacity building among preparers, financial regulators, and other key stakeholders. Tailored to local context and priorities, these efforts should aim to enhance preparedness for evolving SDS requirements and ensure that the voices and realities of all stakeholders are adequately reflected in global sustainability standard setting initiatives. Furthermore, we emphasise that inclusivity in SDS settings should also factor in the balance and proportionality of reporting costs for companies of all sizes, particularly considering the limited capacities and resources of SMEs to respond to increasing reporting requirements. SMEs play a significant role in many emerging market economies, accounting for the majority of employment. Although they are not reporting entities themselves, they participate in the value chains of larger corporations and risk being marginalised should they fail to comply with existing and future reporting requirements. In response to this need, we welcome and recognise emerging efforts in this direction by the ISSB and its global partners, including the launch of the Partnership Framework for Capacity Building in COP27 and the recent creation of the ISSB Knowledge Hub. In particular, we are encouraged by and supportive of an effort recently launched by the GSG with support and funding from the UK Foreign, Commonwealth and Development Office (FCTO) to carry out capacity building and stakeholder engagement activities in key EMDEs in Q1 of 2024, building on an ongoing Portuguese Foundation Foundation-sponsored capacity building effort by the GSG in a select number of ASEAN jurisdictions. These activities are also intended to provide input from the ground up to the international bodies that the relevant organisation is part of, as well as to other relevant organisations, including ISSB, International Public Sector Accounting Standards Boards, that's the IPSASB, the IFVI and IMP. The GSG will work in coordination with other key partners who are also actively working to promote greater inclusivity in the transparency agenda, including the United Nations Development Programme, that's UNDP. We welcome the development and implementation of additional resources that align with this approach, such as a recent joint report by the International Monetary Fund, the IMF, the World Bank and the OECD, which emphasises and provides technical suggestions for inclusivity in climate data and their reference frameworks, highlighting that alignment approaches should be inclusive of all parts of the global economy, particularly SMEs, women and vulnerable groups, and appropriate for EMDEs. Pace and comparability. The current slow pace in developing and implementing SDSs will not meet the pressing need to fulfill global commitments, namely the SDGs and the Paris Agreement goals. Differences in national processes speak to a degree of tension between the need to adapt global standards to local market realities and the aspiration to establish a common framework enabling the comparability of information across different jurisdictions. While upholding due processes and adhering to principles of inclusivity and diversity, we must expedite in a coordinated manner the creation of a truly global baseline for mandatory sustainability-related financial reporting. Non-synchronized approaches towards enhanced transparency reporting requirements across countries could result in unintended distortions at the global level, encouraging capital to flow to areas with lower disclosure demands rather than areas with the most pressing investment needs. Harmonization. Some progress has been made in terms of the much needed harmonization and interoperability of the different emerging reporting standards recognized in 2021 by the ITF as crucial to allowing international capital to make informed investment decisions based on comprehensive and consistent information. However, with companies of all sizes and geographies struggling to navigate inconsistent terminology and alternative standards, it is clear that significant work remains to be done. In this regard, we acknowledge and firmly support efforts by the IMP, that's the investment management project, to facilitate the interoperability of existing frameworks and to build consensus among standard setters and related stakeholders around taxonomies, including key terms and definitions, as well as emerging efforts by the IFRS's jurisdictional working group. Mind the social. Given the rapid progress in climate-related reporting standards, which is disproportionate to other SDSs, the inextricable nature of environmental and social impacts must be strongly emphasized as part of our global aspiration to achieve a just transition to net zero economies that leaves no one behind. For SDSs to be climate first, not climate only, there needs to be a more concerted and accelerated push in 2024 to reintegrate key social dimensions into sustainability reporting. Encouragingly, the ISSB's emerging priorities for the next 2 years include developing social-related standards, potentially focusing on human rights and human capital. Furthermore, international initiatives such as the Taskforce on Inequality and Social-Related Financial Disclosures, TISFD, have the potential to lay the groundwork for future standards. in the same way that the TCFD paved the way for climate-related standards. Much needed progress on the social dimension of reporting will face harmonisation challenges, given that social metrics will be much harder to standardise across jurisdictions than climate metrics. We must also be prepared for potential cultural pushback in some countries. Achieving meaningful progress requires placing people, households and broader civil society organisations at the heart of change initiatives. This involves co-designing change programmes, sharing information through trusted intermediaries, and ensuring that initiatives effectively enhance well-being. Just transition approaches encompassing environmental, socioeconomic, and community voice perspectives could be effective in guiding change processes. Integrity. In 2021, the ITF called for the integrity of disclosed information as a crucial step towards true impact transparency and a means of ensuring that private investors have access to reliable information on the impact of their decisions. Today, we see a promising development in the recent consultation by the International Auditing and Assurance Standards Board, IAASB, regarding the first set of assurance and auditing standards for sustainability-related information. These standards are expected to apply to all areas of sustainability and are due to be issued by the end of 2024. B. Building on the reporting baseline to incorporate impacts on all stakeholders. The scope of SDS is currently under development globally, with the exception of the ESRS that intends to follow a double materiality approach, is largely limited to information on sustainability-related risks and opportunities that affect enterprise value following a single or financial materiality approach. As per our 2021 call to account for impacts affecting all stakeholders, we see a need to support efforts seeking to build on the global reporting baseline in order to include disclosure requirements on impacts that go beyond those affecting corporate and investors' financial performance. Specifically, many businesses, investors and financial institutions currently approach sustainability management, including disclosure, by only addressing specific risks and opportunities that are unique to their operations, including reputational, regulatory, operational and technological aspects. However, what often goes unnoticed is that these impacts also contribute to broader system-wide risks and opportunities, regardless of whether they currently pose quantifiable, entity-specific or idiosyncratic risks. Both categories of impacts are inextricably interconnected, as economic activity relies on environmental and social systems. Consequently, the financial success of enterprises, investors and financial institutions hinges on the health and stability of such systems. A growing body of evidence underscores that suboptimal environmental and social outcomes can erode overall economic performance, thereby affecting corporate and financial returns, given the historical correlation between economic growth and corporate profitability. As such, the single or financial materiality approach to sustainability disclosure and management not only overlooks the intrinsic value of social and environmental externalities and impacts, but also disregards the system-wide risks and opportunities they generate, which can influence corporate and investor performance at any point in time. However, current interpretations of financial materiality do not always recognize the importance of information on entities' contributions to the accumulation of system-wide risks. Investors' exposure to and interest in managing system-wide risks suggests that information on entities' impacts and impact management processes could affect their decision-making, possibly rendering such information financially material. Although there is still a long road ahead, we are encouraged by the ongoing collaboration between the ISSB and the Global Reporting Initiative, the GRI, to enable GRI's broader impact-oriented approach to materiality and reporting frameworks to become interoperable with the ISSB baseline, providing a holistic picture of sustainability performance. While adoption of impact-focused SDSs such as the GRI standards continues to be voluntary, the role of these standards as legitimate guidance should be acknowledged, and their eventual integration into mandatory disclosure requirements should be actively pursued. Finally, consistent with our call for greater interoperability, varying interpretations of materiality as a concept, financial versus double materiality, will need to be adequately addressed. Point C, advancing impact valuation methodologies. In 2021, as we looked ahead to catalyze the necessary shift in impact investment decision-making and capital allocation for impact, we emphasize the importance of supporting leading efforts by academia and other institutions working to advance valuation techniques and methodologies. Specifically, we identified monetary valuation of impacts as a key enabler for the integration of financial and sustainability reporting. This integration is essential for fully understanding and effectively communicating the real value created or destroyed by an entity and enabling meaningful comparisons of companies' performance. Such integration could revolutionize decision making, not only for investors who could access comprehensive financial and impact information under a single monetary unit, but also for consumers and other stakeholders who could analyze and act upon this information using familiar management systems and financial analyses. It is gratifying to note the rapid progress made in the field of impact valuation over the past 2 years. Significant milestones include the establishment of the IFVI in 2022, which partnered with the VBA to develop a standardized impact accounting methodology for the public good and to pilot the methodology in everyday business operations with corporates and investors. The IFVI VBA partnership ultimately hopes to establish a comprehensive system for impact accounting, which will include standardized calculation methodologies, practitioner application guidance, robust audit and data management protocols, and correctly disclosed monetary coefficients akin to the financial accounting and audit ecosystem and its supporting standard databases such as for depreciation and amortization schedules. SVI has expanded its network of practitioners to over 60 countries, offering guidance and best practice standards for impact valuation. SVI has also launched its first standard and guidance for the new principle of social value, titled Be Responsive. This is a noteworthy development as it emphasizes the critical role of incorporating impact data into strategic, tactical, and operational decision-making processes. The Capitals Coalition made important contributions through major advancements in the development of the Capitals Protocol, a unified framework to identify, measure, and value impacts on natural, social, human, and produced capital. It also launched the Global Value Commission, which gathers experts from around the world to drive transparency and accountability in the application of value transfers by organizations. Promisingly, the adoption of impact accounting as a practice by corporates and investors is more widespread than most stakeholders may be aware of. A 2022 survey of organizations by Harvard Business School's IWAI, the Impact Weighted Accounts Initiative, in partnership with VBA, found that almost 60% of respondents were already implementing some form of impact accounting, mainly for internal reporting purposes at 69%, but also for external reporting at 56% and management control systems at 49%. The survey captured responses from 22 countries, primarily from Europe and Asia, spanning 18 industries, highlighting the growing global adoption of impact monetization as a standard practice. Furthermore, recent reports by the VBA show concrete results based on pilots by companies that are already linking impact valuation to corporate decisions. On the investor side, funds like Summa Equity are conducting impact accounting cross-portfolio analyses for employment and environmental impact and publicly disclosing their results. In 2022, Summa Equity calculated that their portfolio impact on climate was €35 million in the positive, roughly 2% of aggregate portfolio revenues, and that their net portfolio impact from employment was €193 million positive, or 55% of the total wage bill. Point D, impact transparency in public sector accounting and reporting. In 2021, we identified the need to advance impact transparency in public sector accounting and reporting as a priority area for development. In fact, for many years, calls have been made for policymakers and national statistic offices to move beyond global domestic product, GDP, as a single measure of socioeconomic performance. GDP, while valuable, offers a narrow perspective on the complex interplay between economic growth, well-being, and sustainability. As part of this movement, governments too may strive towards greater impact transparency by going beyond merely disclosing their expenditure and by measuring and reporting the impacts of their activities. The adoption of public sector accounting practices that prioritize transparency, harmonization, and integrity in impact measuring and reporting can grant decision makers in the public sector a more profound understanding of impacts and dependencies within their national economies. Several governments have taken steps to incorporate well-being into their national accounting systems, seeking to place impact at the forefront of public policy and investment decision-making. In the last few months, for example, New Zealand published its first national well-being report. The EU recognised the need to shift to a well-being economy, and the World Health Organization launched an initiative that calls for well-being to be at the heart of economic recovery. Alongside countries like Finland, Iceland, Scotland and Wales, New Zealand is a member of the Wellbeing Economy Governance Partnership aimed at transforming economies around the world to deliver shared well-being for people and planet by the year 2040. This transformation involves moving beyond GDP growth, the core indicator of progress, towards a broader economic policy that delivers quality of life for all people in harmony with the environment. Australia, Canada and Costa Rica are also among the countries to have worked closely with WIGO in recent months to advance this agenda. In an important and related development, upon request from the World Bank, IPSASB, responsible for setting accrual-based accounting standards for use by governments and other public sector entities around the world, led a consultative process in 2022 to gain support for developing global public sector-specific sustainability reporting guidance. Following this consultation in June of 2023, the IPSASB announced initial work to develop public sector-specific sustainability reporting standards, starting with climate-related disclosures. Linking back to impact valuation, impact-weighted accounts are gaining traction in public sector accounting. Traditionally, development organisations, including governments, have offered incentive packages to organisations considering moving into or expanding in specific regions, aimed to achieve objectives such as job creation and economic growth. However, comparing whether the quality and impact of those jobs justify the costs incurred by the public sector remains a challenge. In the US, the Fresno Economic Development Corporation is working to change this paradigm with an innovative corporate scorecard upon which tax rates or other incentives may be based. For example, rather than offering lower taxes up front, organisations would be evaluated annually based on their impact and incentives adjusted accordingly. One of the critical inputs to the scorecard is the Impact-Weighted Accounts Employment Framework, which has numerous action pathways for organisations to increase their impact by investing in areas with higher unemployment, location impact, diversity challenges, diversity and opportunity, and increasing wages and benefits for workers, wage quality, and health/well-being. These examples illustrate a path towards a future economic system where all stakeholders, both private and public, account for their impact on people and the environment and recognise it as a crucial variable to be incorporated into their decision-making processes. Our renewed call for action. The imperative for greater impact transparency in private and public sector accounting beckons us towards a transformative era of convergence. This journey will reshape the landscape of financial and governance, placing impact at the core of decision-making as we shift to a paradigm of tridimensional optimization of risk, return and impact, which in turn will allow and hopefully incentivize asset and wealth managers to do good while doing well. As organisations and stakeholders collaborate on the transformative endeavour, they chart a course towards impact centre economies. Figure 1 below, which I won't include in this reading, outlines the main public building blocks of the impact transparency pathway, which evaluates progress towards a RAG rating in accordance with the above considerations. For those wishing to read Figure 1 towards impact accounting, the building blocks, it is located on page 20 of the printed version of the ITF State of Play report. In this spirit, we update our calls to actions and recommendations, and these are the recommendations for impact transparency. Recommendation 1. We reaffirm our unwavering support for the work of the ISSB and reiterate our call to build on the ISSB baseline, striving for global, harmonised and interoperable reporting frameworks, or ideally a single framework that encompasses impacts on all stakeholders, extending beyond climate-only disclosure to incorporate crucial social dimensions. In this regard, the EU's effort to embrace double materiality through reportedly progressing at a slower pace and with a narrower scope than originally envisioned represents a positive step forward and should be encouraged. To achieve this, close coordination with the ISSB and other standard setters is essential to avoid the risk of fragmented reporting requirements for companies and other stakeholders engaged in global value chains. Ongoing work by the Impact Management Project, the IMP, to promote greater harmonisation and interoperability across the broader system of impact management resources, including disclosure standards, is deemed essential. Similarly, current efforts to make GRI and ISSB frameworks interoperable should be supported while not losing sight of the distortive risk of ending up with a mandatory baseline as ISSB is adopted by different jurisdictions, and an optional build if GRI remains a voluntary add-on of sorts, should both pass, not advance, with the same potential for enforcement. Finally, a TISFD would be a welcome initiative to advance on a global set of recommendations for inequality and social disclosures. Recommendation 2. We issue a strong call and reiterate our commitment to double down on inclusivity, to ensure that global sustainability disclosure requirements are relevant to and adoptable by companies of all sizes and key stakeholders in both developed and emerging markets. This fully aligns with the G20 2023 Leaders Communique, paragraph 41, which calls for preserving flexibility in implementing ISSB's SDSs to take into account country-specific circumstances. In this context, as evidence indicates that engagement from EMs in global consultations such as those carried out by ISSB in 2022 to 2023 was severely limited, we reiterate our support to the aforementioned upcoming capacity building and stakeholder engagement initiatives by the GSG and the UNDP in EMDEs. Recommendation 3. Recognising monetary impact valuation as one of the most powerful catalysts for positive behavioural and system change, we urge the IFVI, the International Foundation for Valuing Impacts, VBA and other leading organisations in the impact valuation domain to continue to develop a comprehensive impact accounting system. This system should include calculation methodologies, practitioner application guidance, audit and data management protocols, and robust, transparently disclosed monetary coefficients consistent with the financial accounting and audit ecosystem. In parallel, we are calling on corporations, investment professionals, and other key market players to emulate the pioneering organisations in select jurisdictions by building on the adoption of emerging monetary impact valuation methodologies. In accordance with IFEI VBA's work plan, 3 years of intensive development work are necessary before the first comprehensive set of documentation becomes complete. Going forward, we encourage key stakeholders to stay actively engaged in this visionary process, preparing for a future where impact accounting will be the standard practice as we anticipate increased information requirements by regulators. Lastly, we echo the IFVI VBA's view that an international organisation with the necessary legitimacy, credibility and resources such as the UN through its specialist agencies or the OECD should consider adopting and further developing impact accounting methodologies and frameworks into international standards. The success of these standards hinges on the hosting, maintenance and ongoing development of monetary value factors to ensure transparent, publicly scrutinisable comparability reporting. Recommendation 4, we call on governments and other key stakeholders to support ongoing efforts by IPSASB to advance much needed impact transparency for the public sector, while welcoming the early engagement of key ITF members and partners such as the GSG and the UNDP in the IPSASB's inaugural Sustainability Reference Group. Our second pathway for change is a transformation in the supply of opportunities to invest for impact that meets the needs of institutional investors. Our second pathway for change is a transformation in the supply of impact investment opportunities that meets the needs of institutional investors. And that brings to a conclusion chapter 2, which is the progress update on Workstream A, Impact Transparency. For those who wish to follow along on the printed edition, I just wrapped up page 21. So it'll be progressing on to page 22, which is going to be the report on Workstream B, progress update, which is capital mobilization for a just transition. Thank you very much for listening and paying attention. And if you know of a colleague that would benefit from listening to this very, very information-rich and dense report from the Impact Taskforce or the ITF, please do consider dropping a link. This podcast should be available on most podcasting platforms, certainly Spotify and Google Podcasts, as well as Apple for the Apple users. And it's also available as a YouTube channel. The YouTube channel is called Readings in Impact Investing, not investment. And they're just videos with the audio in the background. And if you want to get in touch for any reason, please do feel free to contact me. My name is Daniel Rosehill, public@danielrosehill.com. Rosehill is Rosehill. Have a good day and thank you for listening.